Good afternoon, everyone. Welcome back to the Schwab YouTube coaching channel for our final live class of the day, Building a Stock Portfolio. I'm your host, Kevin Horner. Thank you all for joining me today. I am pleased to be joined by my friend, fellow coach Connie Hill in the chat. She'll get to comments and questions I'm unable to get to today, but I intend to keep an eye on things there nonetheless. But as always, drop your comments and questions into the chat there. We'll try to bring those to the discussion where I can. And if I can't, hopefully Connie can pick up the slack for me there. Thanks as always, Connie. And if you're not already doing so, Connie and I would really appreciate a follow on X. You can do that for us individually, Connie Hill CS and Kevin Horner CS. The X page is absolutely the place to engage with us when we're not hosting classes for you here. It's the best chance you have to get questions answered as well. So another place where you can meet up with us. If you're doing so already, you'll notice that I've been posting where I can a bunch of charts for you throughout the day and the week. Try to do that to give you ideas of maybe what's moving around and what things are perhaps presenting opportunities for us. But as always, we're just trying to kind of open the eyes of traders for what's going on in the marketplace. So with that, let's go ahead and talk about what we're going to cover today. We are going to do a very brief market review at the close here. So right off the jump, we're going to talk about the S&P, the NASDAQ 100, and the Russell 2000 briefly. And then we're going to move into a brief review of the example portfolio that we've been managing. We will then build a scan, or at least rely on the scan that we've built for this class specifically, the one in which we are locating stocks that are uptrending over 3 windows of time, and then we will place a new example trade for the example portfolio. So as always, plenty to get to in the next 40 plus minutes. Let's dive right in. First, remember that our conversation here is exclusively informational and educational. We do not make recommendations. We do not endorse a specific approach to trading the market. We do discuss and encourage, or rather discuss and bring to the table in these conversations technical analysis concepts traders might choose to employ. The way that I do that is by evaluating the individual stocks and the indexes we'll look at, and I bring those tidbits, if you will, of technical analysis to the discussion that way. Now, remember not to make decisions exclusively off technical analysis. We discourage you from doing so. We do think that technical analysis can be one of your decision-making puzzles, though. No, puzzle pieces, excuse me. Now, one other note that is important as it relates to our disclosures, we do work in a paper money version of the platform, the Thinkorswim desktop application. What's important to know about this is that when we rely on scans, many of those scans, particularly those that will incorporate scanning for specific studies like simple moving averages as we do in this class, those will not be available to you in the paper money version. So for those of you who are working in trying to understand the platform, you do need to utilize the live version of Thinkorswim in order to build some of these scans. So just be aware of that, please. All right, and then the last note, as always, options are not appropriate for all investors. We generally are not going to rely on options in this class. We are working diligently to build an equity portfolio that we will manage, and by manage, what that means is hopefully elevating our X strategies along the way. We will discuss exactly what that looks like as we move through things here. So we're going to start with that broad market review, quick look at what we get out of the S&P 500. The most important thing I think that many traders are taking from today's price action is the fact that we got down to that 67.75 area. Our intraday low today on the SPX was 67.75, right on the nose. And we got down there and the bull stepped in yet again. One of the things I've noted a little bit here today, I've been watching the S&P 500 incorporating this hourly bar because we have been back and forth here back to about late November, the 19th, 20th of November. You can see that on this hourly chart, we have pushed into that 7,000 ledge up here once, twice, 3 times, and each time we were met with selling back to the 67.75. What we've done here, everyone, is create that range, and now, if nothing else, remember, technical analysis, it doesn't tell you what's coming next, but what it does give you is a way to set your risk, which is to say, if this S&P 500 were to trade back under the green line here, some traders would take that as a potential signal to lighten up position-wise, right? The risk comes in that we could make a more substantial move, maybe down to the next layer of potential support all the way down here. And unfortunately, while that could be support, not everyone is going to want to take it from 67.80 down to 65.30. You know, a couple hundred points is not great. And in this case, be about 3.7% to the downside. So the question is always, encouragement is to do the math. And the question is, can you sustain the position size you have if the potential exists or the increased likelihood is now there to see this white line in terms of price action? If the potential to maintain and trade within this range holds by virtue of us moving only upward from here, or maybe even testing 67.75 once more, then it's as simple as simply staying in position as long as that level maintains. And the truth is, some of you will say, Kev, I don't care. 3.7%. If we fell back to 65.50, that would look like an area of support to me. If you're that trader, well, then maybe you're not concerned with a move under 67.75. That 3.7% doesn't dissuade you from sticking with your position. I am not telling you that it should. I'm only suggesting that these are concepts that we traders need to build into our thesis, right? We need to have a plan, and you need to know definitively, how are you going to feel if we traded under 67.75? What if we're, traded through the low we just made there at 67.20 back in December, and now the likelihood of us visiting this last level is getting more and more likely the faster or the more we sell down? Traders, honestly, we're not all that good at setting ourselves up properly. What often happens is, if we don't think about this in advance, we put ourselves in a bad spot. So I want you to think about it in advance. Where is it you would move to? What percentage of your investment would you hold? So on and so forth. Have that plan, try and stick to it. Interestingly enough, that white line coincides with the 200-day moving average down there, doesn't it? Pretty close to it. So if we did sell down, many a trader would look at the opportunity to test the 200-day and say, yeah, we haven't seen that since May of last year. And a lot of traders think, hey, let's go ahead and use that perhaps as an entry for a long SPX position. So that's what we're kind of watching as it relates to the S&P right now. Now, the NASDAQ has been a little bit more under pressure. We've talked about this in this class and in Trader Talk as well. The truth is, under pressure, but still moving largely sideways. In fact, we've really just been sideways since September. So you've had all of October, November, and December, the entire fourth quarter. You had half of September, half of February. So we're really looking at about a 5-month sideways and consolidation move, right? And again, because we aren't really trending per se, we are in a longer move trending, right? You can clearly see that we're moving quite nicely upward. Probably no longer the green 20-week moving average. Let's change this to just highlight the 40-week beneath us. I'm going to hide the 20. I'll hide the 200. Just keep the 40 and the 100 in there. And you can see how clean the 100 has been for us. My goodness, back to January of, this is the 40 week, I apologize, in this light blue. Back to January of 23. So following that 2022 rough ride we had where the S&P lost 30+%, we got back in path, or back on trend, I should say, in early January. And for a lot of the rally, it's been above the 40-week SMA. There is a brief dip in here. You all know that, of course, was the Liberation Day tariff tantrum that the market decided to pose there. But ultimately, you've had a big move to the upside, followed by a period of consolidation. And even though we've been under pressure, feeling it in the technology space, particularly in software, the group is holding up quite well. And one final thing we could do here is maybe to do that Fibonacci drawing from the last low that we made in April. And let's just see if the support that we've got in here is coincident with it. And sure enough, I'm going to zoom in once more here. what you're going to see as soon as this thinks about it, there you go. Look at where that support line is, everybody. That's that same 200-day moving average approximately, and it's the 23% retracement. If this level holds as support, many traders would say that that validates a strong uptrend. It is not uncommon to find the 23% as support on a pullback, to find the 38% as support, or even the 50%. In fact, commonly 50 is the number that a lot of traders are looking for in the Fibonacci move. Now, we are nowhere near giving that back. And I think it's providing us some context that we traders need to keep in mind, because if you've been watching the market on a day-to-day basis, you're probably feeling a little bit uneasy about the way that the NASDAQ has acted. And the truth is, it's just in consolidation mode. So not freaking out, knowing some levels under which we would make some changes. That's what we want to be thinking about, right? Where is the spot where you as the trader is going to make a shift or a change to your investment? Now, today in the Russell, the small caps got us a true or pretty close to a doji, didn't they? Our open, and I mean, we closed flat versus yesterday. Our open was at 26.44 and our close at 26.46. So we do have a little bit of a up day here, ultimately holding support, holding the 50-day moving average. You'll notice the rising 50-day here, last tested in late December, tested again here in early February, continues to provide support. Under 2,600, though, that viewpoint changes. So a lot of traders watching the 50-day here, watching 2,600, a nice round figure and another number that humans, we tend to gravitate towards, right? We like those round figures. So, but again, we don't know what's coming next. We just know that under 2,600, that would be a development we haven't seen in some time. Not for the level of 2,600, but because we've been below the 50-day moving average for the first time since November. So it's been working, has been providing some support. So we still have a consistent view with what we've been getting from the market. Let's talk about our example portfolio here. Last week, we did take an opportunity to put on a couple of new positions. I'm going to open that up here in the monitor tab here. So we added, what we're doing as a reminder here, we have separated my building a stock portfolio into the 11 sectors of the market. As you can see, we currently have exposure to staples with Tyson, industrials with Caterpillar, materials we added last week with Cabot and Coeur d'Alene or Core Mining, and additionally energy with ONEOK and Schlumberger. So what we need to do here is just take a quick look to see if we can raise or elevate any of our exit strategies. So let's start with the ones that we are not likely to make any maneuvers on, those being Cabot and CDE. The main reason I say that, they're not in profit, they are in loss. And so we don't want to likely make any adjustments to our current exit strategy. And I'll remind you, when we build these orders, we do so kind of following these guidelines here, everyone. We're trying to stick with our account size is steady at 100,000. That's our overall market value with which we began. And we're trying not to exceed $1,000 in risk tolerance. That doesn't mean that's what we're investing, just the amount of risk we are calculating for. Additionally, our full position size is not going to exceed $10,000. If it does, then we want to be aware of opportunities to reduce risk through profit taking. So we do have a couple positions that are bigger than that. You know, our ONEOK position is a full position share. We put it on, it was a little less than 10,000 and we've got profit. And then our Caterpillar trade is working for us beautifully. And we are obviously a little bit larger than our goal position size, but we are managing it. So we're going to stick with it. Okay. So that's what we're adhering to. That's what we're striving for. We are trading the leaders where we can, hence not seeing as of yet a lot of equities in technology just here. So let's go ahead. I'm going to open up my watch list for the current account so that I can show these quickly. I'm going to go to my chart and we're just going to work our way down things here. Now, the ones like I mentioned, we're not going to make any changes on. We're not going to make a change to Cabot. and you'll see why here. We just put our position on, and our goal here is to stick with it above the 20-day moving average in orange. Now, today's low coincided with the 200-day, with the 20-day, and our horizontal support that we've held there at around 73. So we like the look of that. We also have our 50 share sale beneath it at $70.17. Now, we could conceivably make this and elevate this stop a little bit. So our current level on the 20-day, if we wanted to use the 20-day exclusively here, everybody, the 20-day right now is 73.71. Okay. And the way we've been managing this is with the average true range, otherwise known as ATR. And what we do is we just take the amount of the ATR beneath our trending moving average, in this case, the 20-day, and we are looking to stay within that allotment, right? That $2.58 beneath the 20-day moving average. So again, the 20-day right now is 73.71, and our ATR is 258. So I'm just going to reduce it by 2.58, and that gives me 71.13. And our order here is at 70.17. So we could raise this by $1, approximately, a little less, and we could be working to minimize our losses by that amount, by that little less than $1. But one caveat to keep in mind is that, remember, the 20-day moving average is rising with us. The 50-day moving average is rising with us as well. And we are just beneath the 50-day right here. So are we perhaps taking on a little bit more risk than we necessarily need at this moment? We could say that. It's a little bit less than $1 per share, and we have 50 shares. So we are maybe looking at about a $50 more loss than if we were to elevate our stop right now. But I think by giving this a little bit more wiggle room between now and next week, we might be afforded the better opportunity to elevate this. And what I'm looking for is, I want to see the position making a new short-term high. I want to see it trading above somewhere in this vicinity. And then by elevating the stop, I am now going to be elevating it to an area just below the 200-day in lieu of the 50-day. Ideally, we would see the 50-day already above the 200 when we make this adjustment. That would just be a preference based on the trend basically establishing itself and giving us a new bullish uptrend. We want to give this an opportunity because we have potentially caught this at the window of time where it has turned the corner, right? Look at how this appears on the weekly basis. When you go back and see, we've got a lot of our prior highs were well up here, right? Run around, what is this, 115 or so? But if we drew the trend line through these last peaks, you know what? This has been doing really well since we broke the downtrend line. And if this is turning the corner, we need to give it a little more opportunity, right? And that's why we're going to maintain it. Rather than elevating the stop, which we can do, we want to stick with it for as long as possible. Because if this is turning the corner from a downtrend to an uptrend, well, then we may have been in at a good level. So let's try and stick with it as long as possible. Hence, no change today to Cabot. Okay, next up, let's look at, let's see, Schlumberger. Don't think we're going to have a whole lot to do, although we could make an adjustment here, actually, because Schlumberger is, and right now we are at 47.24, and according to my math here, we would be bumping this up to 48.01 if we did use the 20-day and came beneath it by the amount of the ATR, the $1.60. But that means we're only capturing an additional 77 cents. And while that would be fine, mind you, the stock has, look at how the stock has managed to hold the 20-day. In fact, today on the close, this is a wonderful example of why we incorporate ATR. ATR today below the 20, we wouldn't be stopped out even if we had it moving it up, right? But if we drew, look at where the level was, the line, same low that we made or really close to it. The low back here was 48.67. Today's low, 48.84. Good indication, more or less a hold of horizontal support. Again, we're just trying to stick with this as long as possible. Yes, we could elevate it and take on 77 additional cents or we could increase our stop by 77 cents. Remember, doesn't guarantee our exit's going to increase by 77 cents, right? Because it's a market order, but we're going to keep the SLB order where it is. Again, from an example standpoint, we could obviously raise this, but what we just want to give it a little more wiggle here. Just want to see if we can stick with this as long as possible. Okay, next up after Schlumberger, so we're going to hold the letter there. We're going to do the same here with Coeur d'Alene, CDE. Now, the main reason here is because we built the exit here versus the 50-day. The 50-day today is at 2018, and our current exit is at 1794. The math says that if we were to do so with an elevated stop order based on the ATR of $1.78, we would be moving up from 1794 to 1840. So yes, again, we can elevate the stop, but it's only a difference of 46 cents. So we're going to stay the course with that and see if we can get this a little bit higher. So if we can get this back up above the 20-day, for example, then the potential exists that we could actually, and that is a possibility because earnings are coming here tomorrow. So between now and next Tuesday, we could see a significant move. We don't want to get stopped out on any volatility. We want to get stopped out on a legitimate breakdown, which would mean a change in the short-term trend, hence staying with where we are here on Core Mining. Okay, couple we do want to adjust. Let me take a quick look here. All right, so we've got TSN. I don't think we need to make an adjustment to TSN. As you can see, we fell through the 20-day today. In fact, we closed below it today. So we've closed below the 20-day now 2 out of 3 days. We're going to allow that stop to do its business, which is to hopefully protect us and keep us from losing too much more than our comfort zone here. But we're going to let that go. Remember, we do not reduce our stops by virtue of price action. We spent the time, we built that stop order based on the 20-day moving average. The 20-day moving average does continue to climb here, I should point out. So at 63.96, we run the risk of being stopped out if we were to raise the stop, right? So we don't want to increase the stop risk. We just want to stick with what we've already done. We've done the math. We're comfortable with this, and we're going to stick with it. We could elevate it because the 20-day moving average is higher today than it was this day last week. But we don't want to increase our chance of stop out. We're going to stay the course here. So TSN, steady and status quo. Now we do have 2 that we need to make adjustments on. So let's go to the one Oak trade. OKE has continued upward nicely. Now we've been working with the 20-day, and the 20-day today is at 80.14, and our current stop is at 75.70. Right? Yep, 75.70. So today, to increase or elevate our stop order versus the 20-day at $80.14, the ATR down here is $2.19. And if we did reduce it by that amount, we're going to find our new stop to be at 78.49. And this is all the math I did previous to the show. So if I'm off by a penny or 2 here and there, please forgive me. But we're basically looking at elevating our stop by $2.79 on 125 shares. So a few $100 increase here is certainly on the table. So we're going to do that. We're going to push this up to 78.49, and let's just look at where that resides. It's right about here in my crosshairs, everybody. So that'll be just, as you can see, below the 20-day moving average by the amount of about a $2.19, $2.20 level. Now, we know we can click and drag our stop order up to that zone. So we're going to do that. So up to about 78.49 or so. There's 42. All right, what's it saying here? 78.41. Okay, so that's about 8 cents below. That's fine. That's not going to make or break us. So I'm going to go with that. 78.41, good till canceled. That's good for 6 months, 179 days total. All right. So let's go ahead and send that one off. And we have raised our stop on One Oak. And then, of course, Caterpillar has been our best performer. That's really neither here nor there. I mean, we've got into it at the right time. We've raised our stops. The 20-day moving average continues to move. Everybody, we are absolutely raising the stop on CAT today because the discrepancy is remarkable. Last week, we made a stop adjustment. We are in at 643.36, and we have a $25.50 ATR. That means that we can go beneath the 20-day moving average, 691.85, by about 25.50. And again, my math here puts us to 674.23. That means from that adjustment, everybody, we are picking up nearly $31 in our stop level. So we're elevating our stop by that $31 amount up to 674.23. So I'm going to, in this instance, I'll just right click, cancel, replace, and I'm just going to type over it here. 674.23. All right, we're going to keep that one good till canceled. But again, we're following the same pattern and the same process. Easily repeatable, tracking the moving average. Now, I do want to mention, while we are elevating this to 674.23 and we are still working with the orange 20-day moving average, some of you might decide for one reason or another that the 20-day is too slow, right? Because we are from the close of 760, let's call it 765 to 692. I mean, we're looking at a pretty healthy 73 points. That's a big move. That's about 10%, almost 10% from our close to the 20-day moving average. Not everyone's going to want to stick with it. We will stick with it to reinforce our behaviors, but some of you might prefer the 10-day moving average because it is much closer as support. And if you're willing to give up only about 30 points, well, then that makes sense, right? So some traders would look at that and say, you know what? I'll put a stop by 1 ATR beneath the 10-day moving average. Or some of you might just say, you know what? Forget that ATR. I want to capitalize on the profit opportunity, and I will sell X percentage of my position on a 1 day, on the day it closes below the 10-day, whatever that day is. As soon as it does, I'll sell X percentage. Have a plan, stick to it. That's all I'm saying. All right, we're not going to make that adjustment here. We're going to stick with our 20-day because that's what's been working. All right. So there you go, everybody. We have looked at One Oak, we looked at Cabot, Core, Cat, Tyson. We are good to go. Now what we need to do, and I'm getting right to you, Beth, we're going to talk about what we do in this class to locate our ideas. So we are utilizing the scanning tool. I have built an uptrending in all time frames. It's not really all time frames, of course. What it is, it's uptrending stocks in a space that are above the 20-day, the 50-day, and the 200-day moving averages. So we should be finding stocks in uptrends, moving from lower left to upper right. And that's what I've done. Now, here we are scanning exclusively today in the S&P 500 and in the healthcare space. So that's what I did. I built that as a screen or a scan, a search, if you will. And if you'll notice, when I did that, I've now got that here, uptrending all time frames. So uptrending all time frames just says in the S&P 500. And then I've got it broken down by the sector spaces. So I can even get more detailed if I want. And so can you. right? In the show notes, if you're watching this in the archive, look down below in the show notes. You're going to find one that we have built previously for this class is NASDAQ 100 and technology specific. All you got to do, if you take that script, when you load it in here, it's going to load it as technology, S&P 500, and tech. Just change the space, save it as a specific scan, and give it an easy to locate name for you, and then you can reference it frequently. And you all know the way that I like to reference it is by putting it into a watch list here. So I'll build my watch list. It's automatic. The moment you save it as a scan, everybody, I can go into my personal and I can find it. And remember, all of those targets, those pink targets, that's how I know it's a dynamic watch list, right? So I can do that. And you're right, Helen, I looked at real estate today. I also looked at utilities. It is not to say that we can't. They will both make it to our list. But I found that these are stocks with which people have a little bit less enthusiasm. They don't, even though they're working, they certainly are working. They also don't necessarily provide the trade, right? Because when you think about utilities, you think about REITs, you typically think you want to stick with them for a window of time that'll earn you dividends and interest income here, right? That's one of the main reasons. It doesn't mean we're not going to incorporate it. It just means we have to have a different discussion when we do. So for today, we're going to do the healthcare trade. We're going to look into adding into healthcare. And the one that really caught my eye today was Amgen. So let's take a look at Amgen on this chart. So there's a few things that are going to stand out to me here, everybody. Number one, we've got it just last week made a 52-week high. I know that because we're working on the daily 1-year chart, right? Now, what I also notice is that we broke through an area of prior resistance right here. This was about 345. And we'd been building out, so we'd had this excellent move to the upside following this earnings here back in November. So November 4, we had earnings, and then we explode to the upside. So basically moving through resistance back here. This was at 300, 301. We popped all the way to 345, so we made a lovely 45-point upside move. And the visual kind of looks like an ascending triangle. And the trader here may have said, well, what is the height of our triangle? And it's this range here. It's about 34 points or so. And if we take the height of our ascending triangle, we can activate the line and kind of put it up there, basically just keeping in line with 34 points of upside. And you'll notice, everybody, we've basically made the measured move of the ascending triangle already. All right. So if you were the trader that was long during this window here, some traders would say they were taking profits as we got into this day here, February 6th, and maybe the red day, the bearish Harami day, the fully encompassed in the candle here. This might have been a day where some traders took a little bit of profit just because you made it to a potential measured move target. Remember, this calculation I just gave you, this height of the ascending triangle, that's just an approximation. It's by no means a guarantee to be achieved. But we are going to talk about the bull flag we're building and perhaps broken with today's close. So noting this, outside of our downtrend line, some traders would think this is an opportunity to trade for the height of the flagpole that we just built. And some traders might do that by moving from utilizing the low on this day. Others might use the low follow of the day of the earnings report in this case. So Amgen announced earnings after the bell on the 3rd. The low of that day was 338 and change. Let's call it 339 just for easy math or so. And I'm going to draw that line up to the height of to designate the height of the flag. All right. And that flag went right about to here or so. So it's about 45 points or $45. And then we activate it. And now this is one of those situations, again, when we start talking technical analysis and measured move, drawing, etc. Remember that this is one of those things that's an art and it's not a science. It's also true that technicians, that they'll take a different approach. Some traders will add that height of the flagpole to the bottom of the flag, as I have done initially, which gives us an approximate target in the ballpark of 405, right? So I'm just going to draw that line in, approximately 405. And then some of you would say, you know what, Kev, I appreciate that, but I'm going to draw that line instead of from the bottom of the flag, from the breakout of the flag. And they might look at it like so. And then that puts you up to maybe 415. And the truth of the matter is neither one of those is more right than another, right? The truth is it's an approximation and a potential target zone for somebody, right? And some of you might want to do that. But this class, yet again, this is on trending, buying into equities that are in bullish trends and working with them as long as they can. And our goal is to hold our positions until the trends break or shift. And we can make those alterations along the way, but we're not going to target that upper level to get us out of the trade. We're just going to start a position here, hopefully, and let's see if we can get this thing continuing to the upside. And if we looked at this on the longer term chart, I think you'll see exactly what I'm referencing here. We've had a really good move over, let's put this, what is this here, 10 years? Yeah, we've just broken an extreme long range, right? So the line that we were looking at down there at 345, that was a good resistance. But on the daily chart, the implication is, well, yeah, we could maybe make, 15, 30, or in this case, 45 points to the upside. But when you consider the range that we've broken from, everyone, 345, and our lows were at 260 or so, I mean, we're talking about a potential for maybe an 80-point move from resistance at 345. On top of that, give you 80. That puts you over 425. Now you've got another layer for consideration, right? So we don't want to be kicked out of this trade early. We would love to continue the opportunity if we can get ourselves into it. So we are going to try and be buyers tomorrow. Now, I'm going to have to clean this up a little bit for y'all so that we can see everything here. So again, today's close was at 373. We need to give it a little bit of a wiggle room, don't we? We can't afford to go in and say, just buy at 373. There's no guarantee. And in fact, even if we went to 375, there's no guarantee that we're going to get ourselves into it. But we need to build the trade properly. So oops, I want to do this. Let's go back and eliminate this, put our scratch pad back on, and let's talk about our entrance at what would be 375. And then if we're considering properly our average true range, well, we got to be willing to give up about 965. Let's just round that up to $10. And let's go beneath our 20-day moving average of 355 to 345. Okay, and that's going to give us an approximation. And where does that leave us? Well, it basically means that we'd be pretty much out at the what could be horizontal support. Okay, so we have to know that. And because we are buying into a bull trend, but we have to give us a pretty wide berth in terms of our opportunity here. We have to give up 30 points with a stop order. Then we're going to go with a smaller position than we normally would. So $10,000 here. And, 10,000 means we could probably own like 30 shares or something, approximately. We're going to go smaller than that. So quick math here. If we go in at 375, and let's say I want to do about 5,000 just to see if we can get ourselves into the trade and then consider adding to it down the road some ways. We'll go for $5,000 and divide that by 375 maximum means we shouldn't own more than 13 shares. So we are going to be a bit more conservative. So we're going to go with 10 shares just to keep ourselves in line. And I'm constantly making these types of moves, by the way. When I'm doing the math, if the number is slightly more than a round figure, I'm probably going to go to the lower number. I'm going to round that down. Not at all uncommon for me. So here's what we'll do. We're going to right click in here, buy custom with stop, and we are not going to set our exit limit above, right? So we're just going to trade this for hopefully entrance tomorrow. And we're going to give this a little bit more of a padded limit. I'm going to go all the way up to 380, remembering that even if we get an open trade well below 380, we're not paying 380, right? We're going to get the best price. So if it opens at 374, we're going to be buying at 374 or close to it, as opposed to the 380. We're just trying to increase our likelihood of being in the position. So we're going to adjust this from 100 shares down to 10. And then I need to click this so that my sell stop order is adjusted properly. And we are going to go with 345. And because we like the idea of the stop order, but we don't want to be stopped out, we're going to decrease the number from 345 by a few pennies. And I'm consistently going in at about 94. It was a good year for me. So we're going to stick with that. Change that to good till canceled. And now we have the makeup of our trade for Amgen here for tomorrow. So let's go ahead and hit confirm and send. Just a quick review. We're going to buy 10 not to exceed 380, which means we are not guaranteed to be buyers. But if we do buy, our exit is going to be at 344.94 with a stop, remembering that that's merely a trigger, and we will get a market order to sell if it triggers. Of price. So send that one off. We are all set for that one. Okay. Now, in regard to some of your questions about why not pick other spaces, like I stated, it is simply us trying to build these into proper timeframes. By no means does that mean that real estate or utilities might not be appropriate here. Effort was tied largely to what we've been seeing here. You know, we've got energy, we've got materials, we've got staples, we've got industrials. I went with healthcare today in lieu of utilities and real estate, but I think next week we're going to need to be looking into real estate and utilities. The one note I have about utilities, when I did the scan in utilities, everybody, is that they are at highs. And so oddly enough, when I was giving it consideration here, if we went in here, I'll just give you a quick look at utilities for an example here, and then we'll wrap it up. But I'll tell you, so many of these stocks are at highs. So here's AES. Let's just look at this. AES. Yep, a little bit of consolidation after breaking out. So that one could have been a good conversation for today. That's an interesting spot. And then AEE was the next one on the list. Obviously, these are coming in alphabetically. Again, no recommendations here, but we do need to incorporate utilities and real estate to our broader portfolio since we do not have exposure there. Hopefully, we're adding healthcare as exposure at this point, but we're going to do so as we move into next week. So thank you, Connie, for managing the chat here today. Thanks to all of you for joining, for asking your questions. Remember, we do have this class in a archive for you. You're welcome to go back into the history and pay attention to what's been going on in this one since January, for example. So if you wanted to learn about some of what we've established already, that would be a good way to do so. Continue to follow Connie and me on X, Connie Hill CS, Kevin Horner CS. And if you liked this class today, hit that thumbs up button for me below. We're going to get this archived after a brief review. It'll be available for you probably tomorrow morning sometime. So with that, let's reconvene next week for this class. And if you're looking to reconvene with me tomorrow morning, hosting Trader Talk at bright and early, of course, market open tomorrow, 9:30 a.m. Eastern. I'll be joined by Brent Moores, and we will give you the rundown of the open and see how things are looking in this market. So with that, thanks for being here today. Hope you all have a fantastic rest of your Tuesday, everybody. I look forward to catching up with you again real soon.